We're in a very headline-driven market. But more importantly, when we look back historically at geopolitical events, crisis events, historically, it does cause volatility. Sometimes you see a little bit of a short-term market dip. But when you look at 6 to 12 months later, markets tend to rebound, and it does not disrupt the underlying trend. So we would not sell into this. I think one positive right now that we're seeing, Courtney, is sentiment has gotten very bearish, not only because what's happening with the Fed, but also the geopolitical side, which suggests a little bit of good news could go a long way for this market right now.
What if it's the opposite? What if tensions do escalate? Do you think that investors should use history as a guide and note that there may be temporary dips, but that in the long run, it won't impact our markets so much? Or is that impossible to say at this point?
Well, if it does escalate, I would suspect there will be some downside for the overall markets. But the main question, as we look at the research, is does this cause a recession? And our work suggests that recession risk, even if this escalates, especially in the U.S., is relatively low. Also, I think one positive relative to history is, unlike 20 or 30 years ago, where we were big importers of energy, the U.S. is now also an exporter. So there's some benefit to our companies. When you think more globally, though, I think this does reinforce our longstanding U.S. overweight. When you think about overseas market, particularly in Europe, they're much more interconnected to the energy markets and Russia. So I think there's more downside in those markets, and we would remain underweight.
And so while price of WTI is under pressure here this morning, down about 3% to under $93 a barrel or so, give or take, in general, that's well elevated. Those prices are much, much higher than we were just recently. And I understand you're overweight to energy, as some of these comments suggest. Is that for the year? Is that beyond that? I mean, energy has either been a winner or a loser. There hasn't been a lot of in between. And right now it seems to be a winner. But how long can you stay with that trade?
Well, we've been overweight energy for most of the past year, and even this year, right now, it's up about 20%. So, short term, we think it's due for a pause. I mean, the next best sector is only up 3%, which is staple. So it's up 20%. Some consolidation would be normal. However, an interesting stat, Courtney, is over the last 3 years, energy is still underperforming the overall market by about 60%. We think with a firming economy and still somewhat negative sentiment as far as low allocations to energy, we still think there's upside over the next year. But it will be, volatile, especially with the headline-driven market that we're in right now.
Been a lot of discussion, speaking of headlines, over what the Fed may or may not do. James Bullard was on our air with Steve Leisman yesterday saying the Fed's got to be really careful here. Credibility is on the line. What do you think the Fed needs to do, at least as far as it can, to keep inflation in check and with the next move that it makes on monetary policy?
Yeah, well, we think they need to start moving forward, right? If we look historically at the first rate hike historically, the average unemployment rate was 6%. Today, it's 4%. The average inflation level historically, when they first raised rates, was about 2.4%. Today, it's at 7%. Now, that 7 number is likely coming down, but the big story is they need to start moving forward. From a market perspective, another thing that tends to inject volatility is short term. But as we studied Fed rate hike cycles historically, markets have moved up 11 out of the 12 cycles we studied, because this tends to happen alongside an economy that is improving. That's why the Fed is raising rates, but they all, in our view, behind the curve and need to start moving with the rate hikes.